Hi, in this chapter we'll look at accounting for receivables. Four major topics. We'll talk about the different kinds of receivables, distinguish between normal or trade accounts receivables versus notes receivables and other receivables, which might be from employees. Look at accounts receivable, when we recognize them, how we value them, and how we dispose of accounts receivable. We'll look at briefly at notes receivable, how we determine maturity dates, compute interest, recognizing notes receivable, how we put values on it, and how we dispose of them. And finally, we'll look at financial statement presentation. So types of receivables: amounts due from individuals and other companies that are expected to be collected in cash. Amounts owed by customers that result from the sale of goods or services, those we typically call trade receivables. Claims for which formal instruments of credit are issued as proof of debt. Once it gets formal, then it's probably in a note category, a note receivable category. And finally, the non-trade things, the interest, loans to officers, advances to employees, income tax refund that you would record on your books. So three accounting issues: recognizing accounts receivable, valuing them, and disposing of accounts receivable. So recognizing account receivable, assume that a Jordan company on July 1st, 2010 sells merchandise on account to Polo for $1,000, terms 210 net 30. And so the journal entry to do that is to debit accounts receivable 1,000 and credit sales for 1,000. On July 5th, Polo returns merchandise worth $100 to Jordan. So we're going to debit sales returns and allowance and credit accounts receivable. So they now owe us $900. On July 11th, Jordan receives payments from Polo for the balance, and they took the 2% discount there. So we debit cash for $882, debit sales discount for $18, and we credit accounts receivable for $900. So we found the $18 discount by taking the $900 that they owed us times the 2% that we offered. So value accounts receivable, they're recorded on the balance sheet as a current asset. They're reported at the amount the company thinks they'll be able to collect. Sales on account raise the possibility of accounts not being collected, and valuation can be difficult because you don't know how much you're going to collect. So, if this was a perfect world, if you sold things on account, everybody would pay you. It's not a perfect world, and there are people out there who will buy things and who have no intention of paying, or they have a financial turnaround and can't pay, or they wind up in the hospital and can't pay. And there's all kinds of reasons that people don't pay. But our job is to come up with a reasonable estimate. How much of our existing accounts receivable do we think we'll collect? So we've got two methods. One is a direct write-off. Once we decide that something is bad, we just go ahead and write it off. The note here is that it's theoretically undesirable because there's no matching. The expenses and revenue show up in different periods. The receivable is not stated at a net realizable value, and finally, you can't do it for generally accepted accounting purposes. So we must use an allowance method. Losses are estimated. It provides better matching. Hopefully we match the expected losses in the period we generated revenue. They're stated at a better guess of net realizable value, and it's required by generally accepted accounting principles. So balance sheet presentation, we show accounts receivable 500 less an allowance for doubtful accounts of 25, so it nets out to 475. The allowance for doubtful accounts is a contra asset account. It normally has a credit balance. So accounts receivable has a debit balance. Allowance for doubtful accounts has a credit balance. Sometimes you'll just show it as essentially a $1 amount there, accounts receivable net of 25 allowance. Okay. So the allowance method, companies estimate uncollectible accounts receivable. And to record estimated uncollectibles, companies debit bad debt expense and credit allowance for doubtful accounts. And we already discussed that's a contra asset account. So debit bad debt, credit to allowance for doubtful accounts. And when you actually write off the account, you say, okay, this account that James Company owes us for $100 is bad. You need to write it off. You debit allowance for doubtful accounts and credit accounts receivable. So we'll do some examples here. Assume that the Hampson Furniture has credit sales of $1,200,000 in 2010. Of this amount, $200,000 remains uncollected at December 31st. The credit manager estimates that $12,000 of these sales will be uncollectible. The adjusting journal entry to record the estimated uncollectibles is a debit to bad debt expense of $12,000 and a credit to allowance for doubtful accounts of $12,000. Notice here that we said the credit manager estimates at $12,000. So hopefully the credit manager has some rationale for coming up with that. Although some of it is a guess. I mean, you don't know what's going to happen with your customers. You don't know who's in really good financial position and who isn't. So then on our balance sheet, we would show accounts receivable $200,000 less allowance for doubtful accounts of $12,000 for a net of $188,000. So recording a write-off of an uncollectible account. So the financial vice president Hampson Furniture authorizes a write-off of $500 balance owed by the R.A. Ware on March 1st, 2011. The entry to record the write-off is a debit to allowance for doubtful accounts of $500 and a credit to accounts receivable of $500. So here you can see that we're crediting accounts receivable for $500 and debiting allowance account. So we reduced our accounts receivable to $199.5 and reduced our allowance for doubtful accounts to $11.5. If we net those out, we come up with the same amount we had before. Then, as luck will have it, sometimes these things turn around. We decide that to write off an account, and a year later or 2 years later, somebody comes back into some money and they're able to pay us. So it says that assume that on July 1st, R.A. Ware pays the $500 amount that Hampson had written off on March 1st. You'd make two entries. The first one puts it back on. It reverses what we did to write it off. So we debit accounts receivable and credit allowance for doubtful accounts. And then we go ahead and record the cash and write off accounts receivable. So two-step process there. We have a couple of methods used for the allowance, for figuring out the allowance. I said earlier the credit manager was estimating, and hopefully he had some rationale for it. We have two basic approaches. One is to take a percent of sales, look at our total sales for the year, and look at what's happened to this business in the last 4 or 5 or 10 years, however long we can get good data for, and come up looking at sales, we take a percent of sales to come up with what our bad debt expense should be. And this one has a focus on the income statement relationships. On the right column here is percentage of receivables. We look at our individual accounts receivable and try and analyze them. Come up with how much our allowance for doubtful accounts should be. Typically we can age our accounts receivable. We can look at how old they are. And the rule of thumb here is that the older an account receivable is, the longer we've had it on the books and haven't collected it, the higher of a likelihood is we won't collect it. So percentage of sales, assume that Gonzalez Company elects to use percentage of sales basis. It concludes, hopefully its credit manager and some other folks concluded that 1% of net credit sales will become uncollectible. If net credit sales for 2010 are $800,000, then the adjusting entry is debit to bad debt expense of $8,000, credit to allowance for doubtful accounts of $8,000. If we do a percent of sales, it emphasizes the matching of expenses with revenue. And when the company makes the adjusting entry, it doesn't care how much it already has in the allowance for doubtful accounts. Counterintuitive maybe, but if we're using percent of sales, we're focusing on the expense and we don't look at how much is in the allowance for doubtful accounts. Clearly if that gets out of whack, we'll need to revisit it. So then we'll look at the percentage of receivables, and this would be an aging schedule. You can see for customer Adert, his total is $600, and that's in the 1 to 30 days past due. 300 of it is in the 130 days past due. 200 of it is over 61 days, and $100 of it is over 90 days. Now, if you're the credit manager at this company, are you likely to give Adert any more credit? Hopefully the answer is no, unless you understand something about his business that isn't evident from here. I wouldn't be extending him any more credit. Then we have Bortz, who owes us $300, and that's not yet due. We gave him 30 days to pay, and the 30 days isn't up yet. Then we have Carl, owes us $450. 200 of it is it's between 1 and 30 days old, and then 250 of it is older than that. So we go through and analyze all of these accounts receivable. There's a total of 39,600 in accounts receivable. 27,000 of it is not yet due, and then we look at from 1 to 30 days there's 5,700, 31 to 60 days there's $3,000 that are past due, and so on. And then we have a estimate of how much of those things will be uncollectible. So our best guess is that of the 27,000 that's not yet due, that 2% of that will go bad. And the stuff that's 1 to 30 days old, 4% of it will go bad. If it's between 31 and 60, it's 10%. If we jump over, if it's over 90 days old, our best guess is that 40% of it will turn out to be uncollectible. So we multiply those percentages times the dollar amounts, and then we add them all up, and that's how we come up with the red $2,228. We've added up to 540 to 228 to 300 to 400 to 760. All of that collectively gave us 2,228. And that's the amount we want to have in our allowance account. We're going to adjust our allowance account to that amount. So if the trial balance shows an allowance for doubtful accounts with a credit balance of 528, then the company will make the following entry. Debit bad debt expense for $1,700, credit allowance for doubtful accounts of $1,700. So the $1,700 plus the $528 that's already in there gives us the $2,228. Picture here. Occasionally the allowance account will have a debit balance prior to adjustment, in which case we're increasing the amount. So summary here. Percentage of sales approach looks at the bad debt expense estimate, ignores the existing balance and the allowance for doubtful accounts, and it looks for a matching of cost and revenue. Percentage of receivables approach is probably based on an aging thing. We're trying to come up with accurate valuation of receivables on the balance sheet, and the existing balance and allowance account is considered in the adjusting entry. Companies sometimes sell their entire collection of accounts receivable. Typically they do it when they're really desperate for cash because it's pretty expensive to sell your receivables. Although I guess the other argument you could make is that billing and collection are time consuming and costly, and if you can get someone else to do the work and assume the risk, maybe it makes sense. But my experience, people sell their accounts receivable when they really need money. So a sale of receivables is called a factor, and that factor buys receivables from businesses and then collects the payments directly from the customers. Typically the factor, the buyer, charges a commission to the company that's selling receivables, and fees range from 1 to 3% of the amount of receivables purchased. I've never seen it that low. Usually it's a lot higher. So we're going to assume here that Hendreden Furniture factors $600,000 of receivables to Federal Factors. So Federal Factors is going to buy $600,000 of receivables, and they're going to charge 2% of the amount of receivables. So to do this on Hendreden books, we debit cash for $588,000 we're receiving. We debit service charge expense for $12,000, and we credit accounts receivable for $600,000. So we've just sold all of our accounts receivable, and we sold it for 2%, which is probably a wonderful deal. As I said, in real life, I think that factor is closer to 10%. Credit card sales are really the same as cash sales from a retailer's perspective. And retailers must pay a card issuer a fee of 2 to 4% for processing the transactions. Again, in my experience, 2 to 4% for most cards. Some of them, like American Express, if you're a small volume dealer, that may be higher than 4%, maybe 5 or 6%. And then the retailer records the sale, and the same as if it was cash. So here's a example. Anita Ferrari purchases $1,000 of compact disc for her restaurant from Karen Kerr Music Company using her Visa First Bank card. And First Bank charges a 3% service fee. So to record this transaction by the music company, you debit cash for $970, debit service charge expense of $30, and credit sales of $1,000. So the sale was for $1,000. $30 of it is a service charge that the bank, Visa Bank, is charging, and then we get the balance of $970. Companies may grant credit in exchange for a promissory note. A promissory note is a written promise to pay a specific amount of money on demand or at a definite time. Almost all the notes I see have a definite time involved. Promissory notes may be used when individuals and companies lend or borrow money, when the amount of transactions in credit period exceed normal limits, or in settlement of accounts receivable. So they're probably, for some businesses, notes receivable are real routine. For other businesses, they would be pretty rare. Okay, to the payee, the promissory note is a note receivable. To the maker, the promissory note is a note payable. So you can see on the bottom here that the maker is Calhoun and the payee is the Wilma Company. So there's a little bit of counting involved in determining maturity date, and it's important to be able to determine the maturity date because notes receivable can go into default if they aren't paid on time. So it's expressed in months or days, typically days, but it could be months. If it's a date, then the smaller print down to your bottom tells us how we're going to do this. So imagine we have a maturity date of a 60-day note, and the note is dated July 17th. And that note would be due 60 days later, would be September 15th. And you do this, you ignore the date that the note was issued, but you include the due date. So you may have to take off, as I did, my socks here and count on my fingers and toes the days in July. But we have 14 days in July. We ignore the 17th, but we count the rest of the days to come up with 14. August has 31 days, so that gives us 45. Then we need another 15 days to get to 60. So we wind up there with a total of 60 days. Computing interest is the face value of a note. The interest rate is always expressed in an annual rate times the times the length of the note, expressed in terms of a year, becomes our interest. So Calhoun Company wrote a $1,000 2-month 12% promissory note to settle an open account. To make the entry as follows: debit notes receivable, credit accounts receivable for $1,000. So valuing notes receivable, companies report short-term notes receivable at their cash, or net realizable value. Estimate of cash realizable value and bad debts is done similar to accounts receivable, and allowance for doubtful accounts is used. So if a company has a lot of notes receivable, they might expect that some of them are going to go bad, and we need to set up an allowance for those bad accounts, bad notes receivable. We can get rid of notes, interestingly, in a variety of ways. One, you can hold it to maturity date and have the maker pay you off. Second choice here is the maker may default, and the payee must make an adjustment to the account, write it off or write part of it off. And then we can also sell the note. It's not unusual to sell notes to banks. So honor of note receivable. Note is honored when its maker pays it in full at its maturity date. It's dishonored when it's not paid in full and it's no longer negotiable. So here's an example of the honor of note receivable. We assume that Betty Company lends Wayne Higley Inc. $10,000 on June 1st, and they accepted a 5-month 9% interest-bearing note. Assume that Betty Company presents the note to Wayne Higley on the maturity date. Betty Company's entry to record the collection is debit to cash $10,375, a credit to notes receivable for $10,000. That will eliminate the notes receivable balance, and a credit to interest revenue of $375. We get to $375 by taking the 9% times the $10,000 and then multiplying that result by 5/12. That will give you $375. You can check my math on that. So if Betty Company prepares financial statements as of September 30th, it must accrue interest. Betty Company would make an adjusting entry to record 4 months of interest. So 4 months of interest there would be interest receivable 300 and credit interest revenue for 300. Again, we take the $10,000 times the 9% times 4/12ths to do that calculation. Then when we get paid on November 1st, remember we've already accrued some of the interest. So we'd have a debit to cash at $10,375, a credit to notes receivable, credit to interest receivable for $300 we'd already accrued, and then for 1 month's interest it'd be a credit to interest revenue of $75. So dishonor of a note, we assume that Wayne Higley says it can't pay. If Betty Company expects to eventually get paid, it would make the following entry. Debit accounts receivable, credit notes receivable, credit interest revenue. And this assumes that we hadn't done that previous accrual of $300. So we take the amount we should have gotten paid, we put it back in accounts receivable for $10,000 plus the interest, put it in accounts receivable. So our presentation in the balance sheet, we're going to identify in the balance sheet or in the notes to the balance sheet each major type of receivable. Short-term receivables are current assets. Report both the gross amount and the net amount or the allowance amount. Now on the income statement, we report bad debts expense and service charge expenses, selling expenses, and interest revenue shows up under other revenue and gains. So we also like to do analysis of our receivables, and here we have a ratio of accounts receivable turnover. Again, these ratios are helpful in comparing one company to another, comparing how your company's doing maybe to some industry averages. So here we have net credit sales of $29,462, and we're going to divide that by the average net accounts receivable. We get our average net accounts receivable by taking the beginning and the ending balance in our accounts receivable and dividing it by 2. So we can see that in this case our accounts receivable turnover was 8.1 times. Ratios used to assess assess the liquidity of the receivables. You measure the number of times on average a company collects receivables during the period. So a higher number is better here than a lower number. Then we look at average collection period in days. We take the number of days and divide it by the accounts receivable turnover to come up with 5.1 days. So it's just a tweak of the previous method. The lower the collection period, the better off we are. So that concludes our discussion of accounts receivable and notes receivable. Most businesses have accounts receivable. Most businesses have some bad debts. Obviously, you try and avoid it, but you can't. Study hard.